You may not be familiar with the term high-frequency trading. Buying and selling shares in milliseconds is now coming out of the shadows. Big banks and hedge funds have invested millions of dollars in ultra-high-speed computer trading platforms, each with a sophisticated mathematical formula to spot trends and move faster than traditional investors. There's a whole host of new electronic trading platforms, each trying to be faster than the others.
What makes this so interesting, I think that at no time in the history of markets have we had such a step change in the ability of people to trade because of technology. The technological development has been like a hockey stick. It's just spiked up.
But what exactly is high-frequency trading, and what connection does it have to market turmoil? We sent New York Bureau Chief Scott Gervey to investigate.
From the second floor of this nondescript building in Red Bank, New Jersey, the high-frequency trading firm TradeWorks buys and sells huge volumes of stocks in the blink of an eye. TradeWorks uses computers programmed to detect small price movements, which can be exploited by nimble trading.
Should high-frequency trading be slowed down? We want to ask Irene Aldridge, quantitative portfolio manager at Able Alpha Trading, also Andrew Stoltman's securities lawyer and partner at Stoltman Law Offices. Andrew, I'll begin with you. What do you think are the problems here, and should something be done about it when it comes to this kind of trading?
I don't think there's any question that something has to be done. The hot traders, the flash traders, whatever you want to call them, high-frequency traders, really pose a systemic risk to the United States and to retail investors. I mean, we saw the 1,000-point drop on May 6th. We still don't know the reasons why it happened, and I've been calling for a ban on that sort of trading. There's no redeeming quality when you have people trading in milliseconds or microseconds. Ban it. It poses too big of a risk.
Her latest articles are entitled Computerized Front Running, Another Goldman-Dominated Fraud, and Will Hollywood Go the Way of Enron? Derivatives Come to Movies. Now let's start with the first one I just mentioned there, Ellen, the computerized front running. Walk us through, and I should mention before we get into this that you quote me in the article because I, in fact, invented the technology referenced in the article. But just why don't you walk us through exactly the computerized front running, Goldman Sachs, and high frequency trading? Tell us all about it.
Well, this is a fraud that hasn't even been covered yet by the SEC, and that was why I was writing about it, because it's an outrage, but nobody really understands it. 70% of stock exchange trades right now are conducted by these high-frequency trading programs. They're all electronic, and they're not even doing it when the rest of us are trading during regular hours, like 9 to 3. They're doing it after hours, and basically they're front-running the big trades that come down the pike. They get a little peek ahead of time of the big trades coming, and then they use their high-frequency trading program to nibble at the price until they figure out what the limit price is of whatever the pension fund or whoever is putting in this big order. And when they figure out how high the bidder is willing to go, then immediately the price jumps up to that limit. So they've creamed that spread off the top, the difference between what the real market price is and what the buyer is willing to pay. All right,
let's break this down a little bit. First of all, let's talk a little bit about program trading. As you mentioned, 70% of all the volume on the exchange, the New York Stock Exchange, is program trading or computer trading. And this is trading. This is buys and sells that are put onto the floor of the exchange under the direction of algorithms that have been programmed to go in there and to add liquidity, as some call it, or buys and sells to the exchange. Now, what your article gets into with this computer-aided fraud, basically, is that the algorithmic trading is set up not to facilitate trading, but essentially to facilitate fraud. And one way they do this is by front-running. And then there's another way they do this, which we're going to get into in a second. But let's talk about front-running and specifically broaden that out a little bit. So just walk us through step by step of front running on the New York Stock Exchange or in a trading situation. You talk about it brilliantly in your article. Tell us just a little bit more. Tease that out for us a little.
Well, in the old stock market, the real stock market, where you had actual people on the floor, they had specialists who would maintain the liquidity of the market, as they said, by having a supply of the stock. And then if somebody wanted to buy and there were no legitimate sellers, then the specialist would step in and sell, or step in and buy. So he made a liquid market. But he actually had an opportunity then to see the trades coming in. And so there was a potential there for front running, for him to jump in ahead of the legitimate, or the buyer or seller. But you weren't supposed to do it. There are rules against it. So it was just a minor flaw in the system. But the computers have institutionalized this. They're doing it with every single big trade, apparently, or many big trades. And those big trades are us, like the pension funds. That's our money, or the mutual funds.
Right. So in other words, a big pension fund places an order to buy a large number of shares, and these computer trading, assisted algorithmic trading from the big firms like Goldman Sachs, they essentially, like you referenced in your article, it's like playing poker and seeing the other guy's hands at the poker table. So they see what this order coming through. They can quickly put a buy or sell in ahead of it. When the big order comes in, and it's like the rising tide lifts all boats. It's a large order on the buy side, for example. This would make their little order go up in price, and they book a profit real quick. But they're doing that essentially on inside information. And this is a bit of a wiggle room that was inherent in the old specialist system before computer trading, but now it's been writ large using these computer-aided algorithmic trading to become the dominant way that trades are enacted on the exchange, and it becomes a profit center for firms like Goldman Sachs, who aren't effectively profiting from a fraudulent system. Now, the other aspect of this that you get into in your story is that the algorithmic trading and the high-frequency trading and the program trading is now not just about matching buyers and sellers, but it's about pointing the market directionally up or down. So there's actually market manipulation going on top of the insider trading. Speak a little bit about this.
Well, they can manipulate the price in order to, they can jump in and lift the price up, or they can suppress the price. So this is used in prediction markets, for example, where they predict which politicians are going to win or whether a bill is going to pass. So it can be used for political manipulation, but we're also seeing it in things like Greece and those European countries that are under attack, where the prices are, this would be the bond prices, are pushed down, and so it looks like it affects their credit rating, and so then they have to pay much higher interest rates until finally they were bankrupt, forcing them into the waiting arms of the IMF and austerity measures. And so this actually destroys countries. We're not just talking about making a little profit here, but actually destroying whole economies.